Do you want to maximize your success with NCUA? Join Mark Treichel as he shares with you the insider's view on passing your exam with flying colors. The With Flying Colors podcast is sponsored by Credit Union Exam Solutions by Mark Treichel. If you would like to work directly with the Credit Union Exam Solutions team and receive support to optimize your results with NCUA so you save time and money, visit us at marktreichel.com to find out more.
Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm recording this on January 30th. Last Thursday, the NCUA Board had their January board meeting, and they had two items. They had the annual performance plan, which I will get to in a different podcast, and they had a vote on the interest rate on loans allowed for federal credit unions. And I'm going to summarize my take on that with a quote from Winston Churchill. So during World War II, near the end of World War II, Winston Churchill said, "Never let a good crisis go to waste." And my take on the interest rate risk cap is that they should have raised it and they should not have let this crisis go to waste. And I think net, a 21% rate would be better for credit unions. And I believe it would be better collectively for credit union members as well. So that's my take, and I will kind of walk through where the board landed on this. It was a good discussion, a bigger discussion on this topic than I can ever recall. But by way of background, the board official vote, as outlined in their board action memorandum, staff was seeking board approval to maintain the current temporary 18% interest rate ceiling for loans made by federal credit unions for a new 18-month period. And so this new period for these loan rates is March 11, 2023 through September 10th, 2024. And so guess what? The Federal Credit Union Act establishes that the interest rate that the NCUA has to consult with external parties, establishing an interest rate above 15%. The appropriate committees of Congress, the Department of Treasury, and the FFIEC financial regulators. The agency has received letters from the Senate Committee on Banking, Housing and Urban Affairs, and the Department of Treasury in support of maintaining the loan ceiling rate at 18%. So some would argue that all those letters that came in and the parties that were consulted should trigger where NCUA should go, and that the government doesn't want NCUA to go higher than 18%. And that is definitely one way to take a look at those letters coming in, but I'll explain why that might not necessarily be the case. All right, so much discussion by the board. Chairman Harper spoke to the fact that all three board members were a little bit uncomfortable, that they were all coming from different places. It was very clear that Chairman Harper wanted to keep the rate at 18%. He spoke to the fact that while trade groups were either calling for 21% or they were calling for a floating rate, that when they consulted with the other regulatory bodies that I already mentioned, that they got letters back, communications back indicating that they thought they should keep it at 18%. There was also some discussion that it had been some 20 plus years since NCUA had actually received letters back on this regulation, and that made a light bulb go off in my head, meaning that I don't believe that these other regulatory agencies were sitting there waiting for NCUA to do this rule, which they do every 12 to 18 months. I believe that the reason all these agencies reached out saying support 18% is that somebody at NCUA encourage them to. And sometimes what happens in those situations is just like NCUA, when they get draft comments on regulations, you end up getting form letters. Well, it's not outside the realm of possibility that somebody at NCUA, led by somebody on the board, reached out to all these agencies and said, hey, we could really be assisted if you would tell us that you prefer 18%, because we don't want to raise it. And then sometimes they'll say, well, what should we say in that letter? So I guess what I'm saying is NCUA, in my opinion, likely heavily influenced these letters coming in and what they said so that they wouldn't have to change it above 18%. Now, you can debate whether 18% or 21% is good for members. And I think there were some discussions that, credit card balances are up 33%, and that inflation is causing a burden on the budgets of America. And it's difficult on people of modest means who are a big focal point of what the Federal Credit Union Act speaks to the purpose of credit unions. All of that sure makes sense. But if 18% works for some people and you have risk-based pricing, why doesn't 21%? And to assume that by raising the rate 18 to 21%, that people of modest means are going to be harmed, as opposed to the conclusion that people of modest means might get more opportunities to get loans. And as a matter of fact, board member Rodney Hood gave examples of someone in the Navy who was unable to get a loan because of where they were at rate-wise and where they were at debt-wise, and they were unable to attend a funeral of a family member. There was another example of a disabled Army vet who was unable to get a loan, and that in this instance, the credit union who had supplied the information was saying, hey, if we had 21%, we could serve so many more people. And they had, implying that there were some statistics that showed that between 18 and 21%, there are good people who could get good loans who might not otherwise be able to get a loan. So, the other side of that, again, is really kind of where Chairman Harper comes from, is that a higher rate is just bad, period. Now, the simple fact that many credit union members want to use overdrafts because the overdraft is the best possible source of funds in emergency situations also, to me, leads to the conclusion that an 18 to 21% flexibility can lead to more members getting more loans that help them meet their daily needs. And so I think it's, in my opinion, very short-sighted to, again, not take the opportunity that this inflation has created and allow 21% rates. Now, the other thing, board member Hauptman talked a little bit about the fact that you need safety and soundness reasons, and safety and soundness definition is something you can drive a truck through. So you could easily do that. Again, if the appetite of the board was to go to 21%, they could have supported it. And if they wanted to support it, they could have persuaded the other agencies to write letters of support as opposed to letters of wanting to keep it at 18%, I guess is what I'm saying. Hauptman did go on and say that at one point in time, back when this went in place, I believe in 87, that the prime rate was at 20%, when NCUA had it for a short time, did allow credit unions to be at 21%. By the way, the 15% rate ceiling has never been in place. It's always been bumped up to 18%. And again, that's why I think the opportunity to get it up to 21%, I think net, you're going to get more members helped, and it's going to improve profitability of credit unions. It's going to improve the lives of members overall. And I think, I don't know, in my opinion, it was a no-brainer to raise it to 21% because the stats and statistics support it, and I'm sure that they could have easily convinced staff to support that side. And this really turned into one of those, okay, what does the board want? We can do either. Now, all of that being said, sounds like I'm a little critical of what happened. And while it's not what I would do, I understand why they did what they did. And the debate, again, the discussion and the debate at the board level was far greater, revealing where they're at and what they're thinking, which gets to the fact that they committed to, in April, having a new item at the board. And I actually did a poll on this on LinkedIn, and I found it quite interesting. As I pull up the poll here, bear with me, and let's see. So NCUA in April, for a long time, NAFCU in particular, and I think occasionally CUNA, has said that NCUA should allow a floating rate for federal credit unions that would be indexed to some index, and that even though the 15% is mandated and that the board has to vote every 18 months on going higher than that, that there would be a way to build this rule in compliance with the Act, in compliance with regulations that would allow for a floating rate. NAFCU is fairly convinced that that is legal, and I'm sure that they've done some background on that. So the board has committed that in April that they will take a look at this. And so my poll was, in April, NCUA will reevaluate the federal credit union interest rate risk cap and explore the legal and policy issues of a floating rate ceiling. If legal, what should they do? And by the way, I had 4 options on my poll, and the one with the least votes was they should do nothing, which had 11% of the people voting for that so far. The poll is still in process, by the way. If you are on LinkedIn and you want to influence these poll numbers, go for it. The second lowest is allow a floating rate, which is at 21%. The second highest choice, or the number 3 in order, is they should have approved 21%, which had 25% of the vote. And topping the votes with 43% is they should have done both option 1 and 2. So they should have allowed they should allow a floating rate, and they should have approved 21%. And I'm somewhere in the 21% and the floating rate. I think they're both good ideas. If they could do both, I think that's wise. So that's pretty much where I land too, is do the both, provide options. Optionality is all in all a good thing. Members do good things for their credit unions. And again, I think it's naive to assume that going to 21% is just bad for members, because I think the numbers will show that it's not. So anyway, NCUA in April is going to study this. They talked about the fact that they've already asked the general counsel's office to look at it. And again, a little bit of inside baseball. I believe NCUA knows in their heart of hearts, and the general counsel knows in their heart of hearts whether or not they think this is legal. They've looked at it in the past, unless there's some new novel approach that they're willing to consider. They know where they're going to land in April, and the fact that they're talking about doing it means that they're probably going to conclude it's legal, which probably means they've known for quite a while they think it's legal. They're just kind of willing to entertain it right now. And so they talked about a possible notice of public rulemaking, which is really just a request for comments, which doesn't necessarily have to lead to a regulation. But again, net, it's a good thing if NCUA is taking comment on it. Maybe at some point in the time in the future, there will be an appetite for a floating rate. And I really believe there's a bigger appetite for the floating rate than increasing to 21%. Because if the 2 Republican board members wanted to go to 21%, they could have gone there. I think it was pretty clear based on former Chairman Rodney Hood's comments that he wanted to go to 21%, which means Helpman wasn't along for the ride relative to that he may have wanted to just keep the status quo. I'm not really sure necessarily where he would land on the floating rate. It's going to be interesting to see what kind of discussion they have in April on this, but good discussion at the board meeting on this, followed by a good discussion in April, means that the tide might be turning a little bit in one way, shape, or form. Don't hold your breath for 21% because if inflation starts to go down between now and then, there's no way I see Chairman Harper moving. And as Rodney Hood's term gets closer to its end, which will be in August, ultimately you're going to see another Democrat here, which is going to mean it's going to be easier for Todd to influence and get votes for the things that he wants to do, as opposed to the Chairman Harper Todd, as I called him earlier, Chairman Todd Harper, as he gets that second vote. It's going to be easier for him to get his actual agenda on the docket sometime after August. But again, as board members, terms are expire. Usually it takes at least a year. Now, Harper has the juice and the ability to get that done quicker. We're going to have to see how that plays out and where that falls in the Biden administration and everything else that they're having to deal with. By the way, as I'm talking about board dynamics, I've got a really interesting podcast coming up where I interviewed former NCUA board member Jeff Bassino. That episode will be coming out either the first week or second week of February. So stay tuned for that. All right, so that's it. Again, don't let a good crisis go to waste. I would have increased the rate to 21%, but that's just me. I think that would be good all in all For all practical purposes, that would have been good for credit unions, good for members, and good for net worth of credit unions. That's it. Mark Treichel, appreciate you listening. I hope you'll listen again soon. This is Mark Treichel signing off with flying colors.
Thank you for joining us on this episode of With Flying Colors. Subscribe on your favorite podcast app to hear future episodes where subject matter experts of all varieties will provide tips on how to achieve success with NCUA. If you would like to learn more about how we assist credit unions, check out our services at marktreichel.com.